Thank you very much for joining us here on Urban Debate on Mirror Now. I am Heena Gambhir. A post on a micro-blogging platform by Reserve Bank of India's official handle at 11:27 a.m. triggered a giant buzz. It informed RBI Governor Shaktikanta Das will make a statement at 2 p.m. Everyone, from top bankers to economists to the ARM EMI pair, wondered what will the RBI Governor Shaktikanta Das say at 2 o'clock. Till then, the economists, the stock markets, actually were focusing on the chief of US Fed on Wednesday, the Central Bank of United States, which was expected to increase interest rates. Nobody had a clue about this off-cycle RBI policy meet on 2nd of May of Indian Central Bank, in which unanimously the members voted in favor of 40 basis points increase in the repo rate. Yes, the repo rate, the rate at which RBI lends short-term funds to banks, has been increased by 0.4% to 4.40%. Markets got a bit upset with RBI's sudden rate hike. Sensex tanked over 1,300 points. Remember last time the Reserve Bank of India had changed the repo rate was way back in May 2020 when we were in the middle of COVID pandemic. That time, the repo rate was slashed by 40 basis points. Now, Reserve Bank of India Governor Shaktikanta Das today said that today's increase can be seen as a reversal of May 2020's rate action. The idea is to fight inflation, बढ़ती महंगाई. But while it may soften the price rise blow, this intervention could drill a bigger hole in Aam Aadmi's pockets. Banks, we all know, have already started increasing the lending rate. Now, this significant hike is also expected to be passed on to us. Naturally, if getting money for banks will become expensive, they will make it costly for us too. Now, apart from this, viewers, the Reserve Bank of India has also raised cash reserve ratio by 50 basis points. CRR. It is the minimum amount that banks have to keep with the central bank. This means banks will now have to keep more funds with RBI. The idea is actually to reduce excess liquidity to fight inflation. But for the last 1 year, the mantra was to hike lending rate and spur the economy. And that seems to have changed with the change in geopolitical situation. Listen in to what the RBI governor had to say today.
Based on this assessment of the macroeconomic situation and the outlook, the Monetary Policy Committee voted unanimously to increase the policy repo rate by 40 basis points, by 40 basis points to 4.40% with immediate effect. The last 2 years are a saga of our determined fight against the daunting challenges posed by the pandemic and now the war. We rose to these challenges to safeguard the economy and the financial system from a maelstrom of shocks. We now stand at a crucial juncture once again. There is the collateral risk that inflation remains elevated at these levels for too long. And if this kind of a scenario unfolds, then it can de-anchor inflation expectations, which in turn can become self-fulfilling and detrimental to growth and financial stability. It has been decided to increase the cash reserve ratio, CRR, by 50 basis points, that is 50 basis points to 4.5% of net demand and time liabilities, that is NDTL, effective from the fortnight beginning 21st May 2022. The withdrawal of liquidity through this increase in the CRR would be of the order of rupees 87,000 crore. Inflation must be tamed in order to keep the Indian economy resolute on its course to sustainable and inclusive growth.
Now, at a time when already inflation is making us pay more for everything, be it grocery, vegetables, eating out, cooking gas, or even fuel, now the Janta will have to pay more for EMIs too. If you have a loan with a floating rate, or if you are looking to take a loan for your dream home, then it may start costing you more. But how much? How badly will it hit your pockets? Let's try and understand on Urban Debate at 8 p.m. on Mirror Now tonight. Joining us on the broadcast this evening is Abheek Barua, Chief Economist and Executive VP, HDFC Bank. We are also joined by Saugata Bhattacharya, Chief Economist and Senior VP, Axis Bank. Joining us, Gurucharan Das, who is an economist and an author, also live with us, is Ajay Bagga, a very well-known market expert. Good evening to all of you, gentlemen. Thank you very much for joining us here on Urban Debate on Mirror Now this evening. Mr. Abheek Barua, what was your first reaction when you got to know about this statement by Reserve Bank of India today at 2 p.m.? Did you expect what happened?
Didn't. One was certainly prepared for a rate hike sometime in the future, in the next monetary policy, which is about a month and a half away, but certainly not sort of what we call a mid-cycle hike. So I was quite surprised. And there were two, apart from the timing, the 40 basis point hike was more than what I had anticipated. I thought the convention is to do a quarter of a percentage point, which is 25 basis points. And so the 40 kind of took me a little by surprise. But, given the way inflation has been behaving, and especially the March inflation print, which was significant at 7%, which was significantly higher than what the markets had expected, and also considerably higher than the upper limit of the tolerance band. Perhaps we should have, as economists and analysts, expected both an early rate hike before the next policy, and also expected a larger than usual rate hike. So in retrospect, one sees a lot of justification for what happened today, but it certainly took all of us and the markets by surprise. The markets don't like surprises, and hence there was a lot of turbulence and a sell-off.
Well, absolutely. Markets certainly do not like negative surprises, the one that came today. Mr. Saugata Bhattacharya, what does it mean for people who already have a home loan or any other kind of a loan right now, or who are planning to take loan? Because even before this action by the Reserve Bank of India today, some banks had already increased the lending rate.
Thank you for having me on the show. Loan rates are definitely on the way up. As you know, many banks have raised their so-called MCLR rates. I'm not going to get into the technicalities, which was before, by 0.5%, 0.1%, etc., 5, 10 basis points. So now these rate increases are likely to accelerate. The reason being, about 3 or 4 years back, the RBI had introduced this concept of the external benchmark rate, and a lot of these external benchmarks are linked to the repo, directly to the repo. So I cannot say that the loan rates will rise by a point-for-point match of 40 basis points the way the repo has been raised, because there's a premium built in over the base repo rate in each of these the external benchmark rates. So how much banks think the markets, the borrowers, in other words, can absorb, and a lot of this is retail loans, home loans, personal loans, etc. So how much of the premium can be compressed? Then that would depend on the final pass-throughs to end consumers. But having said this, there is a definite case both for MSMEs. A lot of the MSME loans are linked to the EBLR, and as well as retail loans, particularly home loans.
Okay. Mr. Gurucharan Das, were you in a state of shock as well when you got to know first about this sudden press statement and then the 40 basis points rate increase? Because in a way, if you see, the idea is to fight inflation, but immediately it's going to impact every EMI pair in the country.
You know, I was actually expecting it. I mean, I think it's even too late. I would have done this 3 months earlier. The reality is that I mean, I'm delighted that we kept on with the growth, easy monetary policy and growth focus. But there comes a time when you have to be realistic. Inflation is getting out of control, and I think they have done the right thing. And I mean, as your other commentators have pointed out, normally you do it in a sort of a 0.25%, 25 basis point term, but it was the right thing to do, and it was something that should have been done even earlier, because frankly, the high inflation can become an obstruction to growth as well. So I believe this was staring us in the face. It had to be done, and he's gone ahead and done it. It's something we don't like, and nobody likes inflation, but this is something that you had to do. It's certainly,
Okay.
I mean,
But
I
Mr.
feel
Ajay
that
Bagga, if it was staring us in the face.
Yeah, no, I was just going to add one
Mr.
more
Ajay
point.
Bagga, if indeed it was
too bad. Sorry,
yes,
sorry, Heena.
Yes, go ahead.
I was just going to add the point that it's too bad that it has happened just when the LIC issue is come up, and for the government, this will mean tougher weather in terms of that. I mean, the LIC thing should have come quicker. They should have moved quicker. But this was inevitable.
Okay, this was inevitable. So then, Mr. Ajay Bagga, if indeed this was inevitable, we all knew that it was going to happen. Why did we see such a negative reaction on stock markets today? And how do you see this impacting government's plans of listing LIC IPO, government's plans to get, around 21,000 crore from the LIC IPO, because it happened on a day markets were just preparing to roll that green carpet. I won't say red carpet here, but the green carpet for LIC.
The IPO is through. LIC will come. I think they factored that in, and that's why the timing was like this. What has surprised the market? The Fed moved in March. The Bank of England had moved last year in December. If you were so concerned about inflation, you never mentioned it in the April policy. You kept saying that growth is very uneven. There are too many factors impacting growth yet. We will wait and watch. What was the burning emergency that changed this view in a matter of 3 weeks, when all of you unanimously in April voted to keep the policy accommodative? Second, classical economics. You can't take care of supply side inflation by a blunt instrument like raising the rates. Will you get more oil at a cheaper cost by raising this rate? Will you get commodity prices down? Will you solve the supply side disruptions? Will you get semiconductors to Maruti and Bajaj by raising rates? That is well known, well understood. What do you do in a scenario like that? So we don't go back to 2008 to 2013, when because we took our eyes off inflation, it became very much embedded and it reached double digits. I agree with the constraints the RBI was facing. I don't agree with the manner it was done. We have moved back nearly 15 years. In the 90s, it used to be central bankers would pride themselves on being opaque, on being unpredictable, on surprising markets. Post Bernanke, post Janet Yellen, the whole central banking was moving back to telegraphing their intentions. And if you read back all the MPC statements, few statements back, they said, first, we will move from accommodative to neutral. Then from neutral, we will get into tightening. Here you have jumped from accommodative to doing a 10% rate hike from 4 to 4.4%. Let's not call it 40 basis point. Look at the magnitude. And also what you have done is 3 times in the statement, the governor has said we remain accommodative. That is totally not right. To when you're breaking the back of inflation, you have to use hawkish rhetoric. Because what are you trying to aim at? You're aiming at inflation expectations that they don't get anchored. On one side, you're pulling out liquidity. On the same side, you're raising rates, and then you say we stay accommodative. So I think today was a very poor show. A lot of credibility was lost, and a lot of confidence was lost for the market. I think that's what really hurt sentiments, because you don't know next week, a week later, what will happen. All of us knew that because of UP elections, the oil prices were not raised till March 10th. So, and then they were raised 80 paisa per day.
Right.
Any fourth grade student will tell you that. So the March inflation was underballed. April inflation will come much higher. It doesn't take much mathematics to do that. But will it solve your oil problem? And I have no issue. You have to raise rates, as Mr. Gurucharan Das said. Probably we should have moved last year itself and kept raising 10 basis points. We would be in a much better position. But surprising the markets like this and going back on your word, it destroys confidence.
Is it because the RBI probably wanted to announce this rate hike ahead of US Fed's decision that's also likely tonight? Or is it because it was waiting for LIC IPO to hit?
Is that for me? Sorry,
Mr. Bagga.
who are you asking?
Yeah, God knows what is in their minds. They change their minds in 3 weeks. So how can I predict that? But LIC IPO is going through. There is huge retail and policy holder, excitement about it. LIC IPO is going through. Yes, in April, when nothing changed, we thought that they would let the LIC IPO go through. And what Mr. Barua said, our expectation was June. They will move, either they will move neutral and then look at the subsequent policy, because there was no tearing hurry. You're quoting inflation has been going up for the last 4-6 months. And you should have moved in November when Powell said inflation is no longer transient, it's persistent. Bank of England, Bank of Canada moved in December. Then you should have moved. If you wanted to move before Fed, it doesn't make sense, because the swap OIS market is telling you it's 50 basis point today. There is a huge probability that it will be 75 in June. So the markets are telling you, and the RBI is very sharp. They have 280 plus indicators. They are the smartest people. They understand all that. So these are just stories. I'm just wondering what was the need of coming in today in the middle of LIC IPO and to surprise the market. You could have broadcast it in April and said we are reserving the right. Look at how Powell has been managing. He has been criticized a lot.
Yes.
You read last April statements, we were looking at 2 rate hikes of 25 basis points in 2022. Before that, it was nothing in 22, only in 23. They have lost a lot of their image, but he's stuck to his guns, and he's not got into this mode of doing hawkish moves all of a sudden or surprising markets, because you must understand the kind of money. You let me finish, or you'll keep on interrupting.
Interesting points you have made. No, sir. Quickly finish your point. Go ahead.
No, it's fine. Go ahead, please.
No, sir, you can finish your point. That's okay. Please continue.
So they have changed their policy stance from September to November to December to Jan. So much so that in January, the press meet versus the minutes were a big surprise for the markets. But he's kept very determined on the path. I think today what we lost was that the central bankers last 15 years were very clear, we will not surprise markets. We will take the markets into confidence. Markets are not perched very strongly, robustly. We are in a precarious situation where a lot of liquidity is going out. You will have banks now staring at MTM losses because everyone was loading up on government bonds. Look at the OIS curves for 1, 2, 3 years. Look at where the government bonds prices went today. And with the CRR impounding of 87,000 crores, rates will have to be raised in the whole economy. Over to you.
Okay. Mr. Saugata Bhattacharya, now some important points have been raised so far. And, one question that everyone's asking today is that what is the message really RBI is trying to send? Why couldn't the RBI wait till 7th of June, which is not really far away? Because if, it did not change or increase interest rates in last few months when already inflation was rising, what was the urgency really?
The urgency, as Abheek pointed out first, is that first unusual inflation print, 695 for the month of March, as opposed to the market expectations of 635. So that's one. Number two, we should have got that in the RBI, in the MPC minutes, when Dr. Michael Patra, who's probably the lead communicator in policy stance, when he mentioned that the more you delay, the more it becomes difficult to tame inflation. The third one is probably with the expectation of the April month's inflation print at probably 7.4, 7.5%. It's very, very clear now that the MPC is likely to face 3 consecutive quarters, at least 3 consecutive quarters of 6% plus headline inflation. The MPC mandates tells them, the states, that the MPC will have to write a letter to Parliament explaining why they have breached that upper 6% limit. So all of this probably, as we just heard, that it's essential. So all markets had priced in a 50 basis point hike in June, in the early June MPC review policy. Probably, because they have a lot of internal data which we are not privy to. Ideally, yes, I would have liked them to have signaled before in the April policy itself that we will look at data, our moves will be very data dependent, etc. To be able to signal at least that if there is a requirement, necessity, will come in even off cycle. And finally, the last point in all of this on the accommodative stance that we are talking about, Governor was very clear that his definition, you define accommodative. What accommodative is nobody knows what accommodative is. So the definition of accommodative is obviously going back to the pre-COVID levels. So you used to have a 5.15 repo rate. So now, till we get to at least a 475 or a 5, that will probably be considered a normalization rather than a tightening. And until that point, probably the communication will be it's accommodative. Actually, the phrase accommodative has completely lost its relevance, just like the reverse repo rate, which had shifted to the SDF standing deposit facility rate. So it no longer, accommodative or neutral no longer makes any sense. The correct questions to be asking now is what will be the trajectory of the rate hikes, what will be the neutral rate, what will be the terminal rate in the cycle are the proper questions to ask.
Very important points you've raised. And Abheek Barua, like the RBI governor, while he was reading his statement, also mentioned that the hike that has come today of 40 basis points can actually be seen as a reversal of the cut that we had got on, in May 2020. And prior to that, there was a sudden cut of about 75 basis points. So are you now looking forward to RBI in a way following a similar trajectory? So a 75 basis points hike, something that we should all now be prepared for, going by what he said today, going by what the conditions are right now?
Absolutely, and I would tend to agree with Saugata that inflation has gotten so much out of control, and I guess let me just sort of add another trigger perhaps for this mid-policy move. Perhaps the RBI got to know the April figures, and I think there was a reference to the April number in the governor's communication. And they might have just decided that enough was enough, and it was time to move. So yes, I think given the inflation trajectory which Saugata described, more rate hikes are necessary. This is a process of normalization, and then you actually get into the business of aggressively fighting inflation. So I wouldn't be surprised if there is 3/4 of a percentage point further increase, if not more, because inflation is elevated. And I think a lot of the things that we had assumed that would happen, for instance, a quick conclusion to the Ukraine crisis, and hence a repair of the supply disruptions, that is unlikely to happen. This is turning into a slow burn. I would tend to disagree with Ajay a little on the fact that I think there was at least a view in some sections of the market, and certainly some of the foreign investors that I speak to. Well, Ajay is really the expert, and I'm not questioning him, but I think there was a sense that the RBI was falling hideously behind the curve. And so if you think it's better late than never to catch up, and so the RBI did a quick course correction. And finally, the other point that I'd like to make, and I'm surprised Saugata didn't make this point, because this is one of Saugata's pet themes, that it could be sort of a preemptive move to defend the currency, because if the Fed turns out to be a little more aggressive than the market has priced in, and despite the telegraphing or whatever, subsequent statements by a number of the Fed members have kept the markets guessing. So it's not a done deal yet. If the Fed sort of raises, comes up with a bit of a shock, what we call negative surprise, then you might have seen sort of a lot of pressure on all emerging market currencies, including the rupee. So this is sort of a signal that you're also kind of defending the currency, and in a sense, taming inflation, because a large part of your inflation is imported. The final point that I'd like to make is that the Aam Aadmi is a very complex creature. I mean, there are different there are different facets to the Aam Aadmi. So there is a facet of the Aam Aadmi as a saver or a pensioner whose returns have been badly eroded by inflation. So while the Aam Aadmi is hurting because of generalized inflation, not just fuel prices and so forth, what we call core inflation has been persistently high, and that's not fuel and food, but a whole bunch of other things. So while you sort of focus on this aspect of his borrowing costs going up, maybe you should also sort of look at the other, other parts of the Aam Aadmi's sort of economic anatomy, and see how whether on the aggregate this helps him or not.
Interesting point you've made, Abheek Barua, and I'll get you and Saugata to respond to my next question. But before that, let me also take a comment from Mr. Gurucharan Das. You've spoken about the Aam Aadmi, the saver, Aam Aadmi, the pensioner. We also want to focus on Aam Aadmi, who's our viewer, Aam Aadmi, who's a dreamer too, who wants to buy a dream home, but now everything is getting expensive. And even, he has to think twice before stepping out of his or her home, because anything that he or she wants to do today, be it about traveling, be it about eating outside, be it about cooking, everything is getting expensive. And Mr. Gurucharan Das, while the idea is to tame inflation, which is in any case a very big word, the people of this country want to now know if this hike has come today and we say that it'll tame inflation, will this mean that, otherwise everything else will now start getting less expensive? What would it really mean for the people who are watching?
Well, first of all, I think we have to really realize that we are in a very dire situation. I don't think most Indians actually, because that war is so far away, they really realize how much it has impacted the global economy and how that we are connected to the global economy. And so, as I said, we should not really. I mean, where I disagree with Ajay is that he's concerned right now with the market, and the market can go up and down. The the situation on the ground, as you just mentioned, Heena, the situation on the ground is a very serious one. We don't know. I mean, with I think this is one of the most moments I have seen where one is just not does not know what will happen in a few weeks. And so this was a prudent move. I mean, I think the reality finally has dawned. As I said earlier, this should have happened earlier. But the reality has finally dawned, and that this action had to be done. And so we should just keep our fingers crossed. This is not going to tame your inflation, right? It never does, these kind of actions. But over the long term, it's the responsible thing for us to do for the stability of the country, for the stability of the currency, and overall. So I think this was prudent, perhaps late by about 3 months, but it was the right thing to do.
Okay, it was the right thing to do. Mr. Bagga, will you like to respond? Two of our guests disagreed with what you said earlier.
No, I defer to them. They are much more qualified than me. I am not talking only about the markets. Inflation is, in fact, a tax on everybody. I am just saying that the bigger picture I would have liked to see is the government cutting down the taxes on the oil front. It doesn't make sense to have petrol running at 125 in Bombay or diesel going this high. That's a cost push into the entire economy. Secondly, the inflation which is coming in is largely a supply side inflation. And to destroy demand, to match the supply and demand, that will cause too much mayhem on a very fragile economy already, on a suffering consumer, on a suffering MSME sector. And third, I had already said they should have probably started in November, December with small moves and well-telegraphed moves. There was no need for a surprise move like this. Even now, I think rates will go up 100 basis points in total. So I'm expecting 60 basis points more over the next 6 to 8 months. So by March next year, we will probably be near that old rate of 5 to 5.15. That's more or less factored in. What was wrong was the surprise and the manner. And still, I don't agree that you can call this policy accommodative, because you are taking out 87,000 crores on May 21st. You're taking out liquidity, you've raised the rates, you've raised the base rate, which is the basis for all lending. So 33 lakh crores of consumer loans will get repriced. And the thing is, the lenders reprice loans almost immediately. And when the cuts happen, it takes 6 to 9 months to flow through. I'm not an economist. The economists can comment on that, but the loans will get repriced immediately. All the corporates on whose boards I sit, we have loans which are linked to the repo rates. And immediately tomorrow, we'll get letters of increasing rates. So on your entire 119 lakh crore book, of bank loans, you will have a repricing. NBFCs will have a repricing. So demand will start falling. Companies will find it difficult, but that is inevitable. In an inflationary environment, this had to happen. But I would like to see the government policy also joining into RBI, because as Mr. Das said, this will not solve for inflation. This is not getting you oil at a cheaper rate into the economy. You have to cut the 50% taxes and give relief to the oil consumers and give up some revenues. That time is much needed now.
Okay, Saugata Bhattacharya sir, don't you think this will also, in a way, have an impact on the credit growth targets that the banks would have kept for the current financial year? After a growth of about 9% in bank credit that we saw in 2021, the expectation was that this year it's going to be at a 4-year high of about 11 to 12%. So don't you think this move will also discourage people? Because we don't know for how long the war, the crisis between Russia and Ukraine is going to continue. We don't know for how long our fuel prices will continue to remain 100 or 120 rupees per litre.
You're absolutely right, that there will be an impact on credit. My worry is it will just push credit growth even higher. So for one thing, paradoxically, realize that the hike in the repo rate is actually good for banks. From their bottom lines, their banks' NIMs, the net interest margins that banks have and use for pushing in capital for higher lending. So that this is very positive for banks, because till now all the other cost of funds have been going up, but lending rates had remained relatively stable. So from a bank's lending book perspective, this is good. I'm not making any value judgments on the borrowers versus banks, etc. So that's a different matter altogether. Just from a positive standpoint, this is one observation. Secondly, because of high, you've already seen that the last bank credit growth rate was 11.5%, and we had expected FY23 growth at about 10 to 11% at least, if not more. So one part is because of these rate increases, and this will reflect, as Ajay says, in market rates. So the diversion that we had seen from market-based borrowing, commercial paper, corporate bonds, etc., into bank credit is only going to accelerate from here on. Together with higher working capital demand for MSMEs, for others, for the higher commodity prices, input costs, etc. So all of that is going to happen. Thirdly, I think there is some capex that is happening, that is beginning to show up, private sector capex, not just government. So the kind of increases that you are seeing, given the IRRs that will already, the hurdle rates from a zero cost lending environment, that was already getting impacted. But together with the higher cash flows that we might expect, given government rates are likely to be on the higher side as well. So given that this is a convoluted argument, but that might actually also be another push into a little bit of a higher capex spending. So while the cost of borrowing certainly is going to go up across the board, retail, MSMEs, corporates, I'm not very certain that this in itself is likely to impact credit growth. I think it is likely to remain relatively robust.
Okay. Mr. Abheek Barua, the title of the show today is Rate Hike in You. What does it really mean for the people, for an EMI pair in the country, for somebody who is probably looking to buy a home loan or any other kind of loan from a bank in the near future? Now, when the rates were slashed in May 2020, when we saw the last rate cut by Reserve Bank of India, at that time, not many in the country were in a position to take any kind of a home loan, because we were in the middle of a pandemic and things in any case were in a really bad state. And today also, if we see when this increase of rate has happened, at that time also we are in a condition where inflation is quite high, everything around us is expensive. So, for people, it is a bad news. Whatever might be the compulsions here, the geopolitical situations, the compulsions of growth, the compulsion of taming inflation, for people, it is a bad news. Would you agree?
Well, you have to recognize the fact that high inflation is also bad news for people. And I think the objective is to get inflation down. Unfortunately, it takes a while for these things to work. It's not going to come down tomorrow while rates will go up, the borrowing costs will go up immediately. So I would tend to side with Ajay and say that, moves on the fiscal side, if you sort of cut uh, your indirect taxes on fuel, etc., and sort of make this gesture towards the Aam Aadmi, who
Right. I think we're facing some problem with the connection out there with Mr. Abheek Barua. I'll try and reconnect with him. And meanwhile, if I can come to you, Mr. Gurucharan Das, why I raised that point again was to tell our viewers, because at that time when the rates were really low, at that time also people could not really take enough benefit of those low rates. And now when the economy has started showing signs of recovery, green shoots are visible. Now rates have started going up.
Yeah, I mean, this is the irony. It's sad that we've had these years of low interest rates and an easy monetary policy, and first it was this wretched virus that came and spoiled the party. And now, when our growth rate was beginning to climb up, it's this wretched war that we have nothing to do with, that's come and spoiled our party. It's just very sad, because I really do think that India's fundamentals really are strong, and we have reserves at the moment. Just when the sort of animal spirits were getting going, the private sector was thinking, because demand was rising, private sector was thinking of investing, jobs were going to come, and it's this come in the way. So you can't sort of fight, as the Greeks said, you can't fight fate. Maybe it's our karma or something like that. But I feel sad. We were really on our way now, and I was hoping actually that we could now, given the investment in the budget, that was planned in infrastructure, all these would have created jobs. It's about time that India started seriously creating those jobs. And now this has come. And this response was inevitable. It would have been irresponsible to have just kept that easy street under these situations, and particularly with the volatile global situation. And and this doesn't mean we have to take some of those fiscal measures too. But those fiscal measures ultimately are not the ones that are growth inducing, which is what we really need as a country. We need growth, we need jobs, and we don't need inflation.
Absolutely.
Sad
We had
day.
lost the connection, Mr. Abheek Barua. While you were speaking, I want to give you the last word now.
Yeah, well, I mean, the last word is that there is no free lunch. It's always a question of trade-offs. And you are obviously sacrificing a lot in order to achieve a goal. You are, you're raising borrowing costs for a whole bunch of borrowers, retail, MSMEs, and so forth. But you've you've sort of looked at the trade-off, you've looked at the balance of things, you've looked at the situation both domestically and internationally, and taken a decision. Do I agree with this decision? I do. And that's, I think, all I can sort of add to this to this discussion.
All right. I think we've got both the views here. Some clearly feel that this was the right thing to do. Some feel that maybe it was not the right time to do something like this. But thank you very much, all of you gentlemen, for joining us here on Urban Debate on Mirror Now and helping us understand what this action of RBI really means. Bottom line is the EMIs are going up. If not tomorrow, then maybe day after. Of course, the quantum will be clear once we get to know how much the banks are now going to pass on the rate hike to the consumers. Thank you very much, all of you gentlemen, for joining us here on Urban Debate on Mirror Now this evening. Let's now move on.